Altria stock, ticker symbol MO, is one of the most popular stocks in the dividend community because the yield is very high at 6.7%. The stock has performed very good in the past year, up 21%, and if we take a look at the 5-year chart, up 50%. So in this video, let's see if the stock is a buy. The current market cap is $105 billion, and last year they made $20 billion in revenue. The current forward PE is 11 and analysts have them rated as a buy, although with a price target of 61. Now this dip that you see here in the chart is because they reported earnings last time. And as you can see, last time they beat on EPS by 0.13%. However, they missed on revenue. The reason I'm mentioning this is because they are actually reporting earnings this Thursday. And as you can see, EPS is expected to be lower than last earnings at $1.32 compared to $1.45, and revenue is also expected to be lower from $5.3 billion to $5 billion. In fact, if we take a look at their financials, this company hasn't seen revenue growth in the past 10 years. As 10 years ago, it was $18 billion and now it is currently at $20 billion, so a compounded annual growth rate of just 1%. And in fact, over the past 5 years, revenue has been decreasing. On the other hand, if we take a look at profits, specifically free cash flow, it has been growing very nicely, from $5 billion to $9 billion over the past decade, so almost double. And this is because their margins have been improving. Gross margin, as you can see, is currently at 72%. Profit margin at 43%, and free cash flow margin has also been improving and it is currently at 45%. So although top line is not growing, bottom line is growing very nicely. And if we take a look at the financial forecast, analysts are expecting the exact same for the future. $20.7 billion in revenue this year, growing to $21.5 billion in 2029, so very little growth, and profit from $5.75 per share to $6.24 per share. But remember that even a company with no growth can still give a lot of value to shareholders. And Altria stock is doing this by two ways. And one of those ways, as I've said before, is dividends. They currently pay a yield of 6.73%, which means you get $4.24 per share invested in the company annually. Now, the payout ratio is a very important metric to look at dividends. It is 79%. This is what percentage of their profit is used to pay the dividend. I would normally say that I would like this number to be under 50%. However, in this case, they are generating free cash flow very consistently. So I actually don't mind this, especially when they don't have any more room for growth. And the other way is by buying back shares. As you can see, especially in the past couple of years, they have been buying back around 2 or 3% of their shares. This is very positive for investors because you own more of the company and you share the profits with less people. Altria has an okay balance sheet as they have $3 billion in cash and $25 billion in debt, which I think it's manageable for a company that has a market cap of $105 billion and that is generating so much cash flow. By the way, if you want access to where I've shown all the data, you have my code VALUE for stockanalysis.com in the description. If you are serious about investing, you know that you have to back up your investment thesis with data and numbers. Before we look at the valuation with the discounted cash flow model, we need to see some things that are very important if you want to invest in this stock. What you're seeing right now is the trends in cigarette smoking since around 1965. This is very good news for society, but obviously this is very bad for Altria's business model. However, they are trying to diversify. As we can see in the last earnings report, the oral tobacco category volume is growing and growing and growing. So for example, they have these kind of nicotine patches, and I would say also vapes and snus are becoming extremely popular at the moment. Another positive in the last earnings is that they increased their financial outlook. They said we are raising the lower end of our full year 2025 guidance range and now expect to deliver adjusted EPS in a range of $5.37 per share to $5.45 per share, which is a growth rate of 3.5% to 5%. Now, like we have seen before, this company, although it's not growing top line, they can still grow bottom line because they have very good margins and their margins are increasing. The question is this sustainable forever? And in their last earnings, they also explain how they are returning value to shareholders, which is what we have seen before, and it is because of dividends. Last quarter, they increased the quarterly dividend by 3.9% to $1.06 per share. and they also bought back $712 million in shares. A very good statistic for dividends is that it is its 60th dividend increase in the past 56 years, and they are also expanding the existing share repurchase program from $1 billion to $2 billion. And taking all of this into account, we need to ask ourselves the final question, because in investing, it all comes down to, can I pay a good price in order to make a good return on my money? Well, in order to answer this question, I use my discounted cash flow model, which tells me what returns you would get on your investment if you buy the stock at today's price, which is $63 per share, according to my assumptions. And according to my low assumptions, you would get a 2.7% annual return on your money, middle 7.7%, and high 12.7%. Keep in mind, these returns include the dividend. Why? Because dividends come from free cash flow or profit, so you cannot double count them on a discounted cash flow model. Now, if you want to calculate intrinsic value, we have to put a 10% desired annual return. Why? Because this is what the market gives you. Now, as you can see, I have intrinsic value of $43 per share, according to my low assumptions, middle 56, and high 72. I believe my assumptions are reasonable, as I have the company growing revenue between -1% and 1%, averaging a profit margin and free cash flow margin between 38% and 46%, and I assigned the PM price to free cash flow at the end of the 7 years of 8, 10, and 12, because this is a very low growth company, so I don't think it deserves any premium over the market average of 15. However, if you want to make your own assumptions, I'm going to leave a link to a spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. In conclusion, although I believe Altria is a free cash flow machine, I believe that number one, it's not in a very good industry to be in, which is the tobacco industry. Number two, there's no growth. And number three, the valuation looks a bit stretched. And if we see the stock price going back to around $40 per share, I believe that would be a good entry point that we saw around 2023 or 2024. And please do not fall into the trap of just because a company has a high dividend yield, it's a good investment. I hope you found this video valuable. Let me know what you think about Altria stock in the comments, and I'll see you in the next one.